So the panel members today, and I've only just quickly introduced them, and they'll actually a bit more detail around who they are, what they do, and who they represent. But we've got Nick Griffin from Munro, we've got Stephen Arnold from Aorus, and we've got Sean Roger from Perpetual. So these are the guys that actually handle your money. So it'd be nice to actually hear from them and see what their thoughts are. We're in a quite volatile world at the moment, both economically, financially, and geopolitics. So I think they'll have a lot to say and enlighten us. So, Paul, if you want to go through to the second email, as usual, the disclaimer. So it's not our fault. So, I'll allow you to read that, and I'll pass on to Paul, and you can start the panel session. Thanks, Paul.
Hear me? What about now? Can everybody hear me? Terrific. Hello. Welcome, everybody. I think most of you know me, but my name's Paul Nicol, Managing Partner of GFM Wealth. It's absolutely wonderful to see so many clients and guests in the room today. Thank you for coming out on a rather dreary Melbourne afternoon. James is 100% correct. We have got a rock star panel up here today to have Sean, Stephen, Nick available to us and to you to answer our questions and yours at the end in what is quite an interesting being underlined market environment and economic and geopolitical environment. So Patrick and I are going to do our best to capture that in our questions, but put your thinking caps on. If we don't capture it fully, be ready to ask questions at the end. So as James said, we're going to ask each of the gents now to introduce themselves and the strategies that they manage. That they'll take 3 to 5 minutes each, and then once we've done that, we'll get into the question and answer and go from there. So I'm going to hand over first to Sean.
Thanks very much, Paul, and thank you for everyone for your time and for the GFM team for having us here today. As Paul said, my name's Sean Roger. I'm a portfolio manager with Perpetual. For those of you who don't know Perpetual, it's one of Australia's longest standing fund managers, and we manage in our team about $13 billion across 10 different products. I've been with the business for about 13 years now, and I've sort of been through the team as an analyst and now in a portfolio manager role, and work on 3 of our products, 2 of which I'll talk today, which are the 2 long-short products and then the Perpetual Equity Investment Company. So just 2 of the products. So firstly, the Perpetual Equity Investment Company, that's a listed investment company, so it trades on the ASX where you can buy shares in, and it trades under the code PIC, P-I-C. It's just ticked over 10 years being listed on the market, and the real sort of purpose and the reason the fund was established was to provide tax-efficient returns, predominantly through income, to shareholders, and that really comes through as fully franked dividends. The way we construct the fund is under the sort of broader Perpetual process, which is really anchored around 2 key pillars of quality, but also with a strong sort of valuation overlay over the top. The way we at Perpetual think about quality and screen for quality is we've got 4 quality filters that any company has to pass before we will invest in it. First one of those is it has to have a strong balance sheet. It has to have recurring earnings, so it has to be profitable. It has to have a sound management team. Obviously, that's a call that we make after meeting the management team and observing, I guess, their behaviour and execution over a long period of time. And finally, it has to be a quality company. Again, that comes down to the way we look at quality. I know a lot of people sort of look at quality in slightly different ways. Once a company then passes those quality filters, we then apply our sort of valuation overlay, and we're really looking for opportunities to buy good established companies where they might have fallen out of favour in the short term due to something that we think is just a short-term hiccup, and we're I guess given the opportunity to buy a decent company at a good price. As I mentioned before, I guess the key sort of appeal of the product is its long history of paying fully franked dividends. You can see there over time that the aim is to grow those dividends over time, and it has been the history there is fully franked dividends. Based on the last dividend that we announced in August, the fund's trading at about a 6.5% yield or over 9% on a grossed up basis at the moment, and plenty of coverage there for the dividend moving forward. What's the slide there? And just the second fund that we run is the Perpetual Share Plus Long Short Fund. So I guess the key area that this fund is differentiated from the other fund that I talked about is 1, it's unlisted, but 2, it's got the ability to short. And For those of you who aren't familiar with shorting, basically that is the ability for us to express a negative view on a share price. So if we think the share price of a company is going to fall, through shorting that stock, we're able to generate positive performance and alpha from that view. Now, there's lots of different structures of long-short funds in the market. The one that we run, the Share Plus Fund, is what's known as a 1-25-25 product. And what that means is that we can short up to 25% of the fund, and then with the cash we've raised from selling those stocks, we can then reinvest that money back into the long side of the portfolio to give us 125% exposure on the long side. We often get asked, I guess, why short and what does shorting add? We really view that shorting sleeve of the portfolio as a profit driver in its own right. We've got a shorting process that's been in place for a long period of time with Anthony, who I co-run the portfolio with, Anthony Aboud. And we feel like, one, it provides a really good source to an expanded opportunity set to make money, but it also gives us a lot of flexibility to how we sort of set the fund up depending on how we're viewing the market at the time.
Thank you, Sean. My name's Stephen Arnold from Aorus Investment Management. I've been investing since 1991. I spent 10 years of my career in London, which is where I met my lovely wife. Came back to Australia in 2008 and set up Aorus in 2017. And today we manage about 2.1 billion. And we're very pleased to be partnering with GFM and the opportunity to speak with you today. There you go. Thanks very much. A few of the foundational principles of Aorus. Number one, we are a single strategy business. We are here to do one thing and one thing well. So we run a concentrated long-only global equity fund. Number two, we are a capacity-constrained business. We think that the quantum of money that a manager looks after matters, and there's a size beyond which it can become an impediment to performance. And so we said at our inception that the most we'll manage is $5 billion. And as I said, we're at $2.1 billion today. We're a very transparent business. We show all of our holdings every month, so you can see what you own in our fund and draw a straight line between what we say and what we do. And lastly, we are a staff-owned business. We don't have any outside partnerships. We describe our approach as a quality-first value investing. I'm sure we'll get into this a little bit more through our discussion. But by owning just 15 stocks allows us to set a combination of quality and valuation very high, and that rare intersection of those two factors. And we want to own businesses that grow, become more successful, more valuable over time, and where the risk of a disappointing outcome is low. I think there are some variables of our fund, probably more small text there than you want. Here you can see, as at the end of last month, all of our holdings, a few of the features of those 15 stocks, 6 of them, interestingly, 6 of those 15 are UK domiciled. Quite interesting, quite different. Of those, only one of those companies sells things to consumers. It's a very business-to-business orientated approach. We want companies that provide essential products and services to their customers, mission critical. And lastly, it covers from relatively small businesses, small in a global context, through to the very large. So we have a very selective approach, but size-wise, we straddle the whole spectrum. Thank you very much.
Okay, I'm last. My name's Nick Griffin. I'm the Chief Investment Officer. I'm one of the founding partners of Munro Partners. I've been coming here for a number of years, so I'm going to ask you all a big test. Who knows what a Munro is? Okay, good, it's getting through, thank you. So for those of you who don't know, Munro's mountains in Scotland. So hang on, I'll just try and, oh no, I pushed the wrong one. Munro's mountains in Scotland, okay? Any mountain over 3,000 feet in Scotland is called a Munro. There's 286 of them, and your goal is to go climb them all. And so why did we name our business? And by the way, I haven't done that, by the way. Why did we name our business after the Munros? So I too, like Stephen, spent a lot of time in the UK. In fact, we hung out a bit together during our youth, but we'll tell those stories later. But what we wanted to do, I spent a lot of my time in Edinburgh, Scotland, okay? And I also married a Scot from Edinburgh. And there's these great funds management businesses in Edinburgh, businesses like Ballygifford, Walter Scott, Artemis, the old Standard Life, Aberdeen Asset Management. They're all Scottish fund management businesses. And what they've done really well is they sit in a faraway place and they take long-term views of the world. And so when I came back to Australia in 2015, we set up Munro Partners. And the Munro is a bit of a homage to these great Edinburgh fund managers that we wanted to be like. We're based here in Melbourne, Australia. We run our business as a partnership, so it's a zero goodwill partnership. So the business is worth nothing. You become a Munro partner and you earn equity in the firm over time. And when you leave, you give it back to the next person. Very similar to like JB Were once was when it was great. We run about $7.5 billion in assets under management. We have just over 30 staff. Our offices are right here in Melbourne, Australia. We're literally just trying to solve one really simple problem for you. Is we just think very simply earnings growth drives stock prices. So if a company makes more money every year, generally we find its share price goes up. That's not meant to sound very complicated. Sustained earnings growth is worth more than cyclical earnings growth. The market always misprices growth and sustainability. So I'm showing you two companies there. I've shown the same two companies now for more than a decade. One's MasterCard. The dark line is its share price and the lighter line is its blended forward earnings per share. On the right is Bank of America. The dark line is your share price, blended earnings per share. Now, I'm not saying Bank of America is a bad business. We just think it's a cyclical company. It relies on, interest rates, growth, a whole bunch of things that we have a view on, but we don't have an edge. We want to build an edge on the structurally growing companies like MasterCard. It benefits from the shift from physical to digital cash. Everybody knows this. It's been like this for a decade, and the company just structurally grows over time. And so what we're trying to do is we're trying to segment the world into finding these big structural changes. We want to find that MasterCard situation over and over again. And I won't go into detail on this slide, but this just shows you the top 50 companies of all time in the last 100 years. And you wouldn't believe this, but the top 50 companies over the last 90 years, there was actually 25,000 companies listed. And those top 50 companies make up more than half of the entire returns of the stock market through that time horizon. And so this is really simple. This is a game of few winners and lots of losers. If you look at those top 50, it's always created by big structural changes. So our job is to be your global growth investor, occupy the top left-hand corner of that slide, find the big structural change that's coming, and find the winner. And I'm sure we're going to talk a lot about AI and a whole bunch of things like that today. That's essentially the problem we're trying to solve for you. There's a big change coming. Who's going to win from it? That's what we do. We do well, and we've done it for 10 years, and I hope we do it for many more. Thank you.
Thanks, Nick. Just to echo James and Paul's sentiments, great to see so many clients and familiar faces in the room today. It absolutely is a rock star panel. It's a real pleasure for Paul and I to interview these three gentlemen, and it's good that Paul and I get to interview them because Paul and I actually aren't talking to each other at the moment, or I'm actually not talking to him. I barrack for Carlton and Paul barracks for the Swans, and last week the Swans pinched Charlie Curnow, and this is a really big problem in my household. We've got a dog. He's named Charlie Curnow, so not sure what we're going to do about that. We're hoping that maybe another Charlie gets drafted, but anyway, it's all good. We move on. So first question to you, Nick. Interest rates were zero for a long time there. Have obviously moved off that very low base. How have they impacted your investment decisions, that change in interest rate environment?
Oh, yeah. Look, short answer here, it just makes you be a bit more disciplined about valuation. The reality is everyone in this room now has an alternative to investing in our funds, which is cash. You can earn, depending on which bank you go to, 3.5% in cash. And so what interest rates do is it just makes you a bit more disciplined about the price you pay for companies. So, i.e. slightly lower multiples. When interest rates are zero, that's when you get a lot of this speculative froth in the market, like we had in 2021, and people will buy companies with no revenue, etc. So none of that's going on at the moment. Every company we invest in has a PE multiple. Yes, we pay a little bit higher because we're growth investors, but you just have to be more disciplined about that, and you don't stretch yourself to these other areas like you would in, say, a zero interest rate environment.
Understood. Stephen, your portfolio?
Well, I think economically having a price of risk is very healthy. A protracted period where interest rates are super low, I think, can create distortions and misallocations of capital. So economically a healthy thing. For our portfolio, we anchor our valuation framework on very long-term interest rates, and so it doesn't move up and down when you get these short-term movements in interest rates. I have heard an expression, some of you may have heard as well, that changes in interest rates from an equity investor can be a little bit like the Hubble telescope. You move it an inch and you're in a different galaxy. So having long-term anchored framework, I think, will lead to much better decisions than having a mechanism that moves around with these volatile interest rates. So we feel interest rates where they are today, healthier than where they are a few years ago, but makes no change in how we value businesses because it's anchored on very long-term rates.
Sean, I know the Australian interest rate cycle hasn't perfectly lined up with the US, but for you as an Australian investor?
Yeah, I think for us, and again, the way we sort of look at value opportunities is we often are looking at companies where they've had some short-term challenges for one reason or another. And I think what having a higher interest rate does is it probably even gives us a little bit more pause to be even more selective on those turnaround challenges, because when you do have a higher cost of capital and higher interest rates, there's a higher cost of debt there. And if you're a board or a management team that's trying to fix problems within your business and get the company back on the right ship, if you've got a higher cash cost there, you're going to be less willing to go and make the hard decisions at the cost of short-term profitability, which might be the right thing for the business long-term. Whereas if you've got a company in a sector that's fully self-funding, right on top of its sort of business operations and has got a stronger brand position, that's going to be in a much stronger position in that environment. So I think we're just being quite selective in terms of those companies that have found a bit of short-term trouble, that ensuring that they've got really strong balance sheets, because the higher cost of funding can make an additional challenge in that context.
So Nick, let me ask you, I think everybody is aware that we've had a terrific run in markets of recent times, and particularly global markets have performed extremely well, but it feels like a bulk of the return that's been generated out of global markets been from a handful of the US tech stocks. So I guess it's a two-part question. Firstly, is that healthy for markets? And secondly, in your opinion, do you think that will continue?
Yes, I'll do the second part first. So from our point of view, we think you're probably in the third year of a bull market that's going to go for 5 years, potentially longer. And I think I said exactly the same thing last year, to be honest. So 2022 was a big nasty bear market, particularly in international markets. You mightn't have noticed as much here, but the NASDAQ fell 33%. Your average stock fell 50%. What normally happens out of that is you get 2 good years, which was 23 and 24. And right now we're in a classic mid-cycle year. And so I'm sure I'm going to get to ask the bubble question, but the US market's up 13.5% this year. That's not a bubble. That's a healthy bull market from our point of view. The bubble bit might come, but it'll be in the future. In terms of the narrowness of the market, look, this is something people are going to have to get used to, I think. You know, I've said it a lot, but the stock market's not really the economy. It hasn't been for a long time, and it's definitely not in the United States, okay? The stock market is the top 500 companies in the United States, and there's now 10 of them that make up nearly 40% of that market, okay? And those 10 companies right now happen to be at the epicenter of the AI revolution. And so we're doing this almighty build-out of compute capacity to host all these AI applications that we're using. And again, something I talked about last year and something I talked about the year before. And so that build-out is ongoing. As that build-out happens, that's really about hosting things on cloud data centers, if that makes sense. So a lot of you would use the cloud, but every time you use the cloud, it only goes to 4 companies in the whole world: Microsoft, Google, Amazon, and Oracle. And then when you're buying semiconductors, that really only goes to 3 companies that design them: NVIDIA, AMD, and Broadcom, and they're all only made by one company, which is TSMC. And so this data center build-out around AI lends itself to this narrowness in the market, but these are the companies whose earnings are growing dramatically because of this data center build-out. And as I showed you on my earlier slide, stocks follow earnings. The earnings growth is very strong. The multiples are actually still fine. And so that's what's driving the market at the moment. And that will continue until rates come down enough for the whole economy to broaden out and get the rest of the market to recover. And I still think that's healthily in front of us. So that's the bit to look forward to.
Stephen, I'm going to ask you the same question. So do you think the concentration of returns coming from tech is healthy for the market? And or if it isn't healthy, and you may well say it is that something you think investors should be hedging against?
Well, Paul, rather than take an either-or approach in terms of how we construct a portfolio, we really try and swim in our lane. I think Nick's done a great job of building a portfolio around these long-term structural winners. For us, it's long-term, durable, growing, competitively winning businesses. And for that reason, I think our international fund nicely complements a fund like Munro. In our portfolio, you'll find, for instance, a UK business you've probably never heard of, but almost certainly interact with its products every day of the week. And that's a business called Halma. Halma has increased its dividend by 5% or more for 46 consecutive years. It's a remarkable history of growth and profitability, and it serves a lot of our essential day-to-day needs, including things like transportation and building safety, environmental solutions like water quality and air quality testing, things we don't think about but are essential. They're growing needs and we use them every day. So we've been able to build a portfolio around these durable, long-term growing businesses that don't really play to a theme or a rapidly changing part of the economy or part of the market, and Halma being a good example of those durable, long-term compounding winners.
Sean, switching to Australia, it's hard to pick up a newspaper without hearing about cost of living pressures. How has that impacted your investment universe in the Australian market?
Yeah, it's obviously been a big challenge for a lot of consumers in Australia over the last 18 months. I guess that cost of living pressure and broader sort of inflation. I think our perspective on it, and having the benefit of recently speaking to a lot of management teams and getting all the results in August, is that we're probably through the worst of it. I think both the financial results and outlook pointed to a consumer that's improving, and I think you're still seeing in pockets that the consumer's discerning. So if you look at some of the stronger results in the retail sector, value offerings like Kmart and Chemist Warehouse are still performing very well, which I guess shows you that the consumer is still quite value conscious. But if we then think about, I guess, the next 12 months, you've got rising asset prices with housing and even the stock market driving improved consumer confidence. You've had a couple of years now of improved wage growth, and then we've got some inflationary pressures moderating, although I think I got my insurance bill last week and it still seems to be a lot of upward pressure there, but that is easing. I think you're seeing petrol prices sort of come down as well. So I think there's certainly still pockets of the consumer that's under a little bit of stress, but I'd say more broadly, things look pretty sound for the next 12 months. And from an investment perspective, obviously we've got a reasonable sized retail sector here. So I think the backdrop for those companies looks pretty good for the next 12 months. And I think consumer electronics within that, so JB Hi-Fi and Harvey Norman, they've obviously got the benefit of, I guess, being the conduits of some of these new technologies that are coming out. So I think a healthy consumer and having that tailwind behind them, I think they look pretty good over the next 12 months. And then I guess the only other, one of the other places you really see consumer health is obviously the banks are a huge part of our index here, and a healthy consumer is extremely important for the overall financials of a bank. And in that context, I think we can probably talk about banks later on in terms of valuation, but from a credit quality and consumer health perspective, I think that things look okay there for the next 12 months.
So again, for you, Nick, and you guessed right, we are keen to talk about AI. So I'll set you a little bit of a task here. Firstly, we don't want to take it for granted that everybody actually really does understand what AI is. So your best high-level explanation, and then once you've done that, I think it's fair to say, and you're right, you've been in front of our audience for several years, and we can remember vividly you talking about the AI picks and shovels, and that was a way for you to make money. So once you've explained AI and you explain what the AI picks and shovels are, curious to know if that's still the best way to make money out of AI, or if you're looking at other ways you can make money as well.
How much time do we have? Who's using ChatGPT, just out of interest in the room? Okay, so that's a good chunk of the room now. And for those who are not, you should, because that's the best way to understand AI. It's a free app on your phone. And so when you're using ChatGPT right now, you're asking, about a year and a half ago, you'd ask it a question, it'd give you a one-shot answer. Does that make sense? So you'd say like, you know, how much is Charlie Curnow getting paid to go to the Sydney Swans? And we'd give you the answer. Does that make sense? And, you know, how does that compare to other AFL players at the AFL? And you'd have this conversation with it, if that makes sense. And that's giving you a one-shot answer. Now it actually is thinking about it a lot, okay? So to get the AI better, it's asking itself the same question 100 times to get you a better answer. Does that make sense? And so that means we need more and more compute to get these models to work. And I'll talk about that. That's the compute demand in a second. Okay, so if you think about that one particular app and then just evolve that capability across every industry on the planet, that's the opportunity that AI has today. So the obvious ones are things like call centres, where you're not talking to a person, you're talking to a bot, and that's already happening. Other ones would be like using AI to spot problems on an MRI scan, or using AI to detect who's at your front door as opposed to there's someone at your front door and a security camera, or using AI to drive a drone or drones or swarms of drones in some sort of conflict or anti-conflict, or using AI to build a digital twin of this city to then say, if I build this here, is that going to be a problem? And so you're looking at a technology that's effectively going to evolve across every industry on the planet. because of that one ChatGPT solution, you can work out how well this could scale, okay? So that's the opportunity. That was the opportunity last year. It was the opportunity the year before. So what's happening now is the picks and shovels are playing out. So we are building out this massive amount of data centres to drive these products. And all we have to do, what I said last year, is guess how much we're going to use this stuff. The more we use it, the more picks and shovels are going to be. And the update this year is we think you're going to use this a lot more than you realise. And it's because it's not just going to be a consumer app, it's going to go across all these different industries. So from our point of view, the picks and shovels have performed well. We think they will continue to perform well. We know this because they've announced the data centres they want to build. Some of these things, Facebook's building a data centre that's 3/4 the size of Manhattan. And they're not building one of them, they're building two of them. Amazon's building two of them. OpenAI's building them. I don't know with what money, but they claim they're building them. And so they've only really just levelled the land on these things. They haven't put the chips in yet. They haven't put the Ethernet in yet. And so you should think, the last thing I'll just say here is when we go to see NVIDIA, and we do, seen them every year for 6 or 7 years, had the chance to meet Jensen a few weeks ago. And so from that point of view, when you see them, they tell you, you've got to think about this as not building data centres, we're building AI factories. And we're building factories to build out, to support the intelligence revolution in the same way that we built factories to support the industrial revolution. And they think you should think about this in terms of the next decade, not just the last couple of years. And importantly, we're only 2 years into this, right? So it's hard to see how this stops tomorrow. It could stop in 3 or 4 years' time. It could stop in 10 years' time. But I think this is a boom, and you should embrace a boom. We lived through a boom here during the mineral cycle, like the super cycle, remember? We mined commodities for a decade. Fortescue went from nothing to being this huge company. I bought Fleetwood. They made caravans. Like, there's no IP there whatsoever. The stock went up 20 times. That's what happens in booms. People make a lot of money in a boom. We're 2 years into this one, and I think it'll last for at least 5 to 10. The market will price it in eventually. I personally think we're nowhere near it today.
Stephen, the slide you showed before where you had the 15 companies that you currently own, I don't think anyone could look at those companies and think any of them are of poor quality, but that's only half of the decision that you need to make. You also need to make sure that you buy these at the right price as well. So how do you do that internally to make sure that you don't pay too much for these high quality businesses?
One of them is leaning on long-term history. And I think here, optimism bias is a good sort of frame of reference. And if I tell my wife I'm going to be home in 30 minutes, it's probably more likely to be 35 than 25. So knowing that we're biased to be optimistic, it's a good reminder as to us to lean heavily on what a business has done before getting too excited about what it could do. One of the businesses we might talk about later is L'Oreal. It's been around for 116 years, and so there's a lot of history of its durability and success to lean on. I spoke about Halma, that produces all sorts of interesting devices that make our everyday lives work and work well. 46 consecutive years of growing dividends at 5% or more. So by owning just 15 businesses, it allows us to be very selective. It allows us to be very demanding when we think about quality, allows our judgments to be informed by history, and then importantly, it allows us to overlay a lot of price discipline. Now, finding 50 great businesses is one thing. Overlaying price then allows us to bring that back to 15, where we think we've got quality and growth on our side, and we've got valuation on our side.
And another thematic that I'm very keen to talk about is decarbonisation. Now, I don't think it really matters whether you believe in the sciences or not. I think we're decarbonising, whether it's countries, whether it's corporates, whether it's households. There's no doubt we're decarbonising. So I'll start with you, Nick, and then I'll ask you too, Sean. But I don't know what the addressable market for decarbonisation is, Nick. I'm not sure if your team's done that. But do you think this is a compelling thematic, and who do you believe are going to be the early or the enablers of decarbonisation at this stage?
Yeah, so thank you. So the beauty of the decarbonisation, it allows you to diversify the funds. So I just talked a lot about AI, and we're excited about AI. We have been for a couple of years, but it's really about a third of our investments. The hard bit at the moment is finding investments that are not AI related, and this is one where we're trying to decarbonise the planet. We think it's roughly $50 trillion, but I haven't got that exactly right, I'm sure, to decarbonise the planet. And that's $50 trillion in revenue to the companies that enable it. And look, I agree. Look, people have to realise that it's not government policy that decarbonises the planet. It's companies. It's companies like BHP who's trying to get to net zero, or Commonwealth Bank that's trying to get to net zero, or Walmart that's trying to get to net zero. And what that does is it doesn't mean that they just buy a whole bunch of renewable energy. It means they change the HVAC system in their building because it needs to be a 6-star building, or they move to more of an electric car fleet, or they move to better recycling. And we've all had challenges trying to work out what we can and not recycle, but clearly we're trying to do more. The one area for us that I'd talk about at the moment is batteries. We like batteries a lot. We recently participated in, so I should say this because I've been nasty about China on this stage before. We went back to China this year and we bought CATL at the IPO in China. They're the world's largest maker of batteries on the planet. They have about a 40% market share. They have the lowest defect rate. They have the highest margins. And batteries go into everything. They're in the buses here in Melbourne, which is exciting. But they're in the buses in China. They're obviously going to cars. But they go into to help support renewable energy facilities as well, to allow wind and solar to work at night or when the wind's not blowing. And in China, they're putting batteries in ships now. They're putting batteries in trucks. And eventually, if we do get the army of robots, and I'm not saying we will, but they're all going to need batteries as well. So we like CATL. We like this area because of the diversification it offers us.
So for you, Sean, a two-part question, if you don't mind. The first part is it possible to get a quality exposure here in Australia to decarbonisation? And the second is, I'm sure you more than me read a lot of annual reports and look at a lot of result presentations, and at the forefront of the result presentations is companies talking about what they're doing to decarbonise. How important a consideration is that for you now when you're selecting companies for your portfolio?
No, thanks, Paul. And look, I think to answer the first question is we certainly don't have as much choice as what Nick does globally in terms of direct decarbonisation, I guess, investments in Australia. But I think there are certainly a few companies that will play a critical role in the broader transition, and I think are pretty interesting investment opportunities on that front. I think if we take a step back, and again, Nick touched on it here, in Australia, we've had a lot of investment broadly in terms of electricity system in renewables, in wind and solar, and for one reason or another, I won't get into policy decisions, but we've ended up with this situation now where we've got, when it's sunny or windy, we've got too much power during the middle of the day, and we've got negative wholesale electricity prices, but we haven't solved the problem of baseload power. So when the peak demand's there early in the evening, the sun's not shining, we don't have enough power, and trying to turn off the traditional sources of energy in that environment mean that we're going to continue to have a lot of volatility in prices. So one way that we think you can play it in Australia, and Nick touched on this, I think batteries are going to have a really, really important role in this moving forward, especially on a wholesale sort of level, where if you've got companies that can use that cheap power in the middle of the day to charge up the batteries and then release that power back into the grid when demand's high and price is high, that helps to then enable us to increase I guess, overall renewables in the system. So for us in Australia, look, there's a little bit sort of odd exposures, but one company that we think is pretty well placed for the battery things is Origin Energy. So obviously it's a retail business and traditionally has been a generator through their coal assets and gas assets. They will shut down over time, but what's attractive about them is where their generator sites are is a great spot for a battery, because for a big battery you need connection into the grid, and having those existing sites, they're in the process of rolling out batteries at the moment. We think that they're going to do quite well early on with those batteries. A second smaller company, which I'm sure not many people have heard of, is a little company called LGI, so Landfill Gas. And what they do is they have contracts with local councils and they basically mine the methane gas that builds up under those tips. So instead of releasing it into the environment, they can turn that gas into electricity and then sell it back into the grid. And they're also putting batteries on those sites as well. So I think, again, we don't have as many options, but I think batteries will play a really big role in decarbonisation moving forward. I think Origin and LGI are pretty well placed. Just really quickly on the companies themselves, look, I think we're seeing some good action from a lot of, especially the big emitters, in terms of trying to reduce their emissions, and the safeguard mechanism in Australia is putting pressure on that. For us, it's really understanding just what exposure those companies have and what they're doing to make sure that they are on that annual reduction path, because if they're not, the cost of carbon will start to bite at some stage, and it ultimately will impact the financial investment.
Sure. Maybe sticking with that, we asked Stephen and Nick the question before about market concentration. It's a very different market concentration here in Australia, with us being dominated by the financials and the big miners. I guess finding structural growth and value with those representing really, really big parts of the market, where do you think the opportunities are at the moment?
Yeah, no, I think that's spot on. And realistically, it's a challenge we're faced with, whereas if you've got a strong structural growing company in Australia that's doing well, it's often valued at a very, very high multiple relative to international peers. And part of that is because there's a bit of a scarcity premium. We just don't, the index is dominated at the top end by those mature businesses. We don't have that many options of really high quality companies. And that makes it challenging. I guess we've got a strong value focus in our portfolio, I guess, to get exposure to those themes. What I think it does mean is that we have to be a little bit creative in terms of how we get exposure to those structurally growing companies. So that may be you're either going down and looking at some small to mid caps that haven't yet proven out that they're long-term structural growers, but if you can identify that trend early, and as they mature from small business into big businesses, that's one area where we've had, I guess, decent success. And the other area is looking at quality companies, we say, that have got stubbed toes. So great businesses that for one reason or another have come under pressure for a short period of time. A good example of that would be a company like Goodman Group, been a fantastic success story over the last sort of 15 years. In 2022, when interest rates went vertical, the share price fell from $27 down to $17, and all of a sudden you had a business that's delivered 10% plus earnings growth for a long period of time, trading on sort of 17 or 18 times earnings, and pouncing on those little moments are how you get exposure. Another one would be ResMed, which is the sleep apnea CPAP machines. When the weight loss drugs, the GLP-1 drugs really came onto the scene 18, 24 months ago, the ResMed share price got hit really hard due to concerns about what that may do to overall demand or overall requirements for CPAP machines for sleep apnea. So being ready to pounce on those sort of high quality opportunities when they pop up, I think is really important. In terms of today in the market where we sort of see that, I think healthcare is an area where there is still some good structural opportunities. ResMed, I still think the multiple it's trading on relative to its market position earnings growth looks pretty good. And even a business that's just come onto it's Sigma, but Chemist Warehouse, valued quite richly now, but it is a genuine category killer in the industry they operate. As the business gets bigger, the model gets stronger. And they've got, I think, a lot of growth runway here in Australia and offshore.
Okay, these guys are being a bit too nice to each other, so we're going to get the gloves off and make it spicy now, right? They're agreeing way too much. I'm going to pick on Stephen and Sean. So, Stephen, your strategy, you exclude entire sectors from your investable universe. And I'm going to pick on a couple. You don't invest in banks, as I understand, and you don't invest in energy. Whereas, Sean, you certainly have an exposure to these industries. So I'm going to ask you, Stephen, why do you refuse to take an exposure, let's say, to banks and energy?
Well, for a few reasons, Paul, and I think Sean partly touched on it. It's the quality of the opportunities that we have offshore that's simply not available onshore. Also, our banking system in Australia, I think, is far better regulated and concentrated than is the case of most banking systems. So when we think about banks and insurance companies offshore, for most of them, they're naturally very leveraged, opaque, very regulated, and we can be a lot less confident about the earnings growth prospects there than we can when we think about a L'Oreal or a Halma or other businesses in our portfolio. So being selective, owning just 15 businesses, and thinking about the opportunity set, for us, we think our capital's better off in sectors other than banks and insurance companies. When it comes to energy and mining companies, we like businesses, our style, we like businesses that are consistently profitable, in control of their own destiny, where politics and policy doesn't matter in the way that it does when it comes to energy prices and commodity prices generally. Supply shocks aren't an issue. You don't have the cyclicality that's inherent in commodity businesses. So for us, we're very selective. We've got a very, very large no-go zone. Sectors like the ones you mentioned, we simply choose to avoid in preference for the quality of the opportunities set that we have offshore.
So I think that's interesting, Sean. No-go zones, cyclicality, control of their own destiny when talking about energy and or commodity businesses. You invest in these companies. So what's the counter-argument for investing in those?
Yeah, thanks, Paul. You really made them sound very interesting there. But Look, at the end of the day, being a value sort of investor, we are very open to investing in cyclical companies. And I think the key thing to understand when investing in cyclical companies is that you know it's a cyclical company, because what that then means is you are focusing on where you are in that cycle. You want to be buying a resource company or an energy company when the prices are low, but you've got a view that they're going to increase, because what naturally happens is share prices will reflect the current sort of commodity price environment. But if you can call that correctly, what tends to happen, or what does happen, is the share price will follow the commodity price up, and the market will become overly positive when there's been a supply shortage for one reason or another. So we're open. We think energy and mining and commodities play a very, very important role in the functioning of society. And I think with the data centre build out, we're seeing that at the moment, where the growth in data centres is increasing that demand for energy. So we still think that it plays a very, very important role. And just being aware that it is cyclical, we think you can still make good money playing, I guess, throughout those cycles. In terms of the banks, well, I think the Australian banks are really interesting. If you look over the last sort of 7 to 10 years, they've really, this includes the Royal Commission period, but they've sold a lot of their adjacent, the wealth businesses, and they've become very, very focused on mortgages, residential mortgages. And basically, there's not a whole lot of growth in the sector, but outside of an increasing competition, to have a big spike in asset deterioration or credit quality, you're basically making a call that Australian house prices are going to stop going up and they're going to go down. And for us, there's so many sort of drivers heading one way that we can't make that bet. So overall, we think that the environment for banks and the asset quality there looks pretty sound in Australia over the next 12 to 24 months. The challenge we've got is just valuation, because they don't have a lot of earnings growth. And after the moves over the last 24 months, they're trading on pretty rich sort of valuations. Just one thing, though, I would say on the banks that we're thinking about. Again, we've talked about AI a lot. In terms of the direct applications, we look at a lot of, I guess, old school businesses, and thinking about how AI can impact them is something that I think is really, really interesting at the moment. And banks are a business model that are very heavy on people and very heavy on processes, and they should have an opportunity to take a lot of cost out over time. I think it's going to take probably 2 or 3 years before we really see that come through, but that's something that may change the environment of not much earnings growth for the Australian banks.
Still being too nice to each other, but that's okay. Nick, you've given us 2 unbelievable investment themes in AI and decarbonisation. I'm going to be really tricky and ask you for a theme that's perhaps flying underneath the radar that you see emerging over the next 5 years.
Yeah, I've got 2 choices here. I'm probably going to go with one that we've had a lot of success with recently, and obviously is security generally. So here we're talking about defence spending. People have come to realise that defence spending is part of a functioning democracy, whereas it was being shunned for a long time. And we've had a lot of success with, say, European defence companies, as Europe's had to lift their defence spending to 2% of GDP was their previous NATO target. And thanks to the Donald, it's now 3.5% of GDP. So that's 10 years worth of investment that they need to do because of the very unfortunate thing that obviously happened between Russia and Ukraine. So that's been a good area where something changed, like it changed quite obviously at the time. And we were able to invest to benefit from that big structural change, and that's been good. The other part of security is a bit closer to home, to be honest, which is more to do with policing. So we're finding some really good companies that are helping police do their job better, effectively. So here we're talking about, some people would notice the body cameras on the police force here in Victoria. They're called an Axon body camera. They're made by a company called Axon in the United States. They also happen to make the Taser as well. And so the beauty of these cameras is they flick on for the policemen. The policemen, naturally, they didn't want them originally, but now they love them because they basically can record what happened, and so you don't get stuck in a he said, she said situation. It's a very hard job to do, to be a policeman. And what the camera can now do, it can actually, using AI, can turn what it saw into a police report, because it can turn video into text. And so it takes what it saw and turns it into a text into a police report, which again saves the policeman time. And then now what they're doing with those cameras is they're rolling them out, because the cost of the technology goes down. They roll them out to nurses, they roll them out to shop assistants, etc., who can all use this to basically help life be a bit easier for these people. And so that's Axon. And the reason why we love these companies is they're a hardware company, but because of AI, they turn into a software company. Does that make sense? And they sell that as a subscription now. And we've found other ideas like this, like Motorola Solutions makes the police radios, for instance. And now the police radio through AI can translate. So you're in a difficult situation, you need to do a different language, your radio will do that for you. And so these are all the technologies that are coming, and I recognise some of this is going to sound a bit Big Brother-ish, But I think Big Brother is coming because AI through these cameras is going to be able to facially recognise. Has everyone noticed when they go to the US now, they take your picture, and when you go to check in on the plane, they just need your picture? I'm pretty sure that's not the only 2 times they've used that. I'm pretty sure they're using that as you walk around the United States, okay? And look, this has been happening in China for a long time. We're investing in the companies that are leveraged to this. And I think, particularly here in Victoria, this is a theme that's going to help you get re-elected. And so we think this is a structural change in an area that we'd like to invest in. And again, non-correlated to those other 2 areas we talked about.
So I'll direct this question at you, Stephen, but I'm certainly happy, Nick and Sean, for you guys to jump in as well. We've heard about lots of good ideas around what to buy, whether it be industry-based or company-based. We've heard about investment disciplines, what our panel here is prepared to invest in and not invest in. I think one of the arts of investing is also potentially having a very good sell discipline. So let me start with you, Stephen, and then I might divert to Nick and Sean as well. But how would you, firstly, I hope you've got a sell discipline. I suspect you do. And how do you construct a sell discipline? How do you go about doing that? So you've done something well out of something, or maybe not done well out of something, and you think you need to sell it.
Well, it's an interesting topic, Paul. It's, I think, part of the investment process that doesn't get nearly as much attention as it deserves. As it happens, Aorus releases a quarterly report where we create a feature article or a white paper each time. The one that we're releasing next week, the subject is our sell discipline. So if through your GFM advisor you get access to the Aorus quarterly report, so you can go onto our website, have a look next week if you'd like to know more about sell discipline. I think for us, one part of it is recognising that great businesses don't necessarily stay great. And often thought process I go through is just imagine we're getting into a time machine, and I sort of visualise maybe it's a Doctor Who, you jump into the phone box, and here we are back in 2005. And if we went around the room and we constructed a list of some of the world's great businesses in 2005, and then we had that piece of paper and we came back to today, I think we'd find that a lot of them are not as great as they once were. And on that list may have been businesses like a BMW and a Procter & Gamble, Coca-Cola and Citigroup, and there'd Intel perhaps, and there'd be many more like that. Still around, still good, but no longer great. So that notion of, to put a word, fade is the word that we use, the great businesses becoming less great. We look for great businesses becoming more great, who are anti-fade, who are repelling that gravitational force back to average. And we think we found 15 of them. But sometimes what's going on is the norm, that these great businesses we thought are getting better are actually decaying. So part of the sell discipline is to recognise it, to have a high sensitivity for the early warning signs of fade, and secondarily to have the fortitude to do something about it. As an investor, it's easy to sit on a hand and tell ourselves it'll all come right next year, but oftentimes it doesn't. So I think that we've done that well, but not perfectly, but well. In fact, 2/3 of the stocks we've sold over the last 7 years have underperformed after we sold them. So I think that's a good sign that we've been able to exit for reasons of price. Sometimes a business is still great, but it's no longer great value. Other times a business we thought is great is not as great as we thought it was. So having that discipline, the fortitude and the selectivity has come together in a very important part of the process, that sell discipline.
What about you, Nick? So not only about the sell discipline, but you, like Sean, you will also short sell as well. So perhaps identifying what you think are structural losers or companies that just aren't getting it right. So the whole sell side and companies that you don't like.
Yeah, okay. So everyone has a sell. We have a mathematical sell discipline, so we set a 5-year price target. We want the company to be able to double within 5 years. So we generally want the earnings to double structurally, like I showed you, within 5 years. And when they get there, they generally, the good ones, they keep going. They grow for another 5 years, another 5 years, like that MasterCard slide I show you. That's the good side. The bad side is what do you do with your mistakes? And here we have a fairly unique process, and I think this is important. What's Mike Tyson? Mike Tyson, my favourite financial advisor. He says, everyone's got a plan until you get punched in the face, okay? So sometimes you get punched in the face. We run these things called stop losses. So if a company falls 20% from peak or from cost, so in line with what Stephen said, have have an early warning sign. That's our early warning sign, and that's where we're forced to review our decision. We're forced to review the idea we had. I once thought that HelloFresh would be bigger than Woolworths. Okay, that proved to be wrong. And it came out of the pandemic, and I thought HelloFresh would keep going, and we'd made a lot of money on it, and like everyone's got it now, we're going to be food boxes till the cows come home. I appear to be their last customer in Australia, as far as I'm aware. But what happens is it falls 20% from peak, and we're forced to review it. And then we might call the management, we'll call some people, we'll come up with a discussion. But this is where we start to work as a team, by the way. It's not up to me anymore. Once the stock triggers, it's up to a team, and anybody can trigger somebody else out of an idea once it's triggering. And sometimes, these things are like, relationships. Sometimes you need your friend to tell you you've got to let it go. And that's where the team really helps you get through that. So that stop loss process we find very useful. I'm pretty sure everybody in this room has a stock they've lost 80% of their money on. It's probably sitting in the bottom drawer. It seemed like a good idea at the time. You just didn't have a reaction function to deal with it. It's fine. It happens all the time. Just deal with it quicker. That's how we think about that. On the short sell side, look, yes, similar to Sean, roughly 10 to 20% of what we do in one product, which is the product we run for you guys. And there we're just trying to invest in the structural losers. And so back in the day, that would have been Woolworths. And again, that would have been wrong. But the point is like, find the company that's losing out of this. We've had a lot of recent successes here. The one I would point to, which is near and dear to my heart, but we've been shorting beer. Beer is unfortunately a shrinking product in the world today. It's had 4 negative years in a row. I know it makes me sad too. But beer is a structurally declining industry, and those are some companies we've been shorting in the last 12 months and had a good experience making money because they're selling less beer and their share prices are going down alongside their earnings.
And what about you, Sean, from a perpetual or a domestic market perspective?
Yeah, one thing we look for, both, I guess, to exit long holdings, but also on the short side, is we use red flags as good indicators that something might be changing within a company. And what I mean by red flags is basically we're observing the behaviour of the management teams and the boards to try and see signals that they're seeing something on the horizon they don't like before you see it in the financial results. And some of the, I guess, high profile red flags we look for are, first one would be strange acquisitions. So when a company makes a really large acquisition or a step out acquisition away from their core business, it's often a signal for us to step back and say, hang on, what's going on here? Because the thesis is that if a company can see deterioration in their core business, one way of sort of plugging that gap is through going and buying another company and getting access to the cost synergies or something that comes with it. Really good recent example, James Hardie, high quality company, made a very large acquisition at a very big multiple. A lot of question marks about why they do that. A couple of months later, at their latest result, we saw why, because their core business outlook had deteriorated significantly. So that's something we look for. Other things we look for is if the insider management is starting to sell a lot of stock, or you're seeing the accounting become more aggressive. They're the sort of things we look for that may give us a bit of signal that, I guess, the core business might be starting to soften a little bit at the edges.
Spicy question. There's been a massive shift and continues to be a massive shift of funds towards passive. This is for everyone. So the most important thing that you guys do on a day-to-day basis to validate active management, i.e. charging a fee for what you do versus just going and investing in the index and getting the results at the end of the day?
Yeah, so I just think you need to be differentiated. So as we said at the start, we want to be your global growth investor. So we're going to be a bit glass half full and try and find these big structural changes and investor benefit from them. And so that makes our returns quite different to the index and thankfully better than the index since inception. But obviously they're going to have to continue to be better than the index. Otherwise you're better off just investing in the index. And so our way to do it, when I showed you that top left-hand corner of the slide, is try and find what's changing and get there first, if that makes sense. So find where the big structural change is happening and then find the winners. And those companies will end up becoming big parts of the index. Like we bought Amazon, it'd be 12 years ago now. It's in the top 10 in the world, right? It's a big part of the index now. And so we bought NVIDIA 6 years ago. It's now the biggest company in the world. That's what you're paying us to do. And we have a way that we do it by identifying the structural change. And as long as we stay differentiated and do that well, then hopefully we keep giving you the better returns that justify the slightly higher cost. Marginally high cost.
Marginally high. Stephen, you've got to answer the same question, but a very different way, please.
I think our key differentiator relative to an index is avoiding material losses. So if you think about an index, think about 500 stocks, well, 20 of them are going to be in the worst 20% of the market, and that's average. You don't often think about what's in the index. You think about the index returns and you decompose it. And of course, there's winners and losers. So for us, it starts as a very conservative approach. And over the last 7.5 years, we've had a very good, statistically very good outcome in terms of our success in avoiding the worst parts of the market. We've owned 44 stocks, 43 of which haven't been in the worst 20% of the market. And that's a great foundation for good long-term risk-adjusted returns. Part of that's our exclusion zone, stay away from the parts of the market that we're more likely to have problems in, and then having a very selective approach of what we want to own. And then thirdly, as we just touched on, a good aptitude for finding those early warning signs of fade. So it's a little bit like the difference between 2020 cricket and Test cricket. You know, there's all sorts of lights in action and excitement around hitting the ball out of the park. That's great. Our starting point is avoiding the losers, and we've done a good job of that. And that's January 1 every year. Our focus is get to the end of the year with no representation in the worst 20% of the market.
Tough gig. Last question, Sean. What the other guys haven't covered, views on the way you add value versus an index?
Yeah, so I think firstly, having a very consistent investment process, which Perpetual's had for 30 or 40 years now, I think has been proven through cycles, and the index, shift to index has been going for a long time, will probably continue, but there is a natural equilibrium for it at some point where it becomes so heavy that the active managers who's left at that time, I guess, can move in front of that and sort of make a lot of money. I think what we're seeing in the Australian market is this shift to index investing is really what's driving some of this momentum at the moment, where companies that are winning and are doing well are continuing to be bought at any price, whereas companies that have got uncertainty or aren't going so well are being sold at any price. And you're seeing that in some of the old market darlings that have fallen 50, 60, 70%. Think about a Domino's, Treasury Wine and CSL, these sorts of companies. And part of it is because index flow is so material as part of the share price movements of those companies. Where I think we can, I guess, stand out moving forward is there's going to be massive opportunities to make money out of this, both from companies that are being sold down really aggressively. If you can pick that things are improving for them and they're going to come out the other side, it's a big gap to go from a very depressed multiple on depressed earnings, if things improve, to then getting in the winners camp, and vice versa. A company that's being bought up a lot with the index money, trading on a big multiple, if it has a few issues, again, it's a big fall before you then see the active managers come on the other side. So I think there's going to be more volatility moving forward, and I think having a long-term discipline process in that environment will put us in good stead.
Okay, we've got 3 questions to go that we're going to ask each of the panellists, and I'd really encourage everybody to be tuned into these last 3, because we're going to ask the guys to put their thinking caps on, look forward, but also reflect. So we all understand there are risks in the market, and sometimes those risks are unforeseen, as by definition, unforeseen is not seen. But what I'm going to ask each of the panellists, and I'll start with you, Sean, and we'll work across, is, other than an answer of the biggest risk that you see right now is a recession or inflation, which could perhaps be rather obvious risks, is there an unforeseen risk or a risk that you don't think is being adequately priced into markets at the moment? So we'll start with you, Sean.
Yeah, thank you. Look, I think for us, I was thinking about this on the plane on the way down this morning. In no way I'm saying that I'm expecting this to happen or that it's likely to happen, but thinking about some of the applications of AI at the moment and what that may mean for employment within businesses is something that's occupying my mind a little bit at the moment. Whereas in Australia, we've got a lot of people-heavy sort of process businesses, and you're starting to hear and you're hearing from a lot of the companies that they are making redundancies, or they're not growing. Their aim is to keep headcount flat while sort of the business grows. And I think if we start to see a bit of a trend there, and then all of a sudden we see unemployment tickle up a little bit, it may become a bit of a theme that might, I guess, in a market where we've got a big exposure to banks, may cause a few wobbles. Again, not saying it happened. AI is probably going to be very good for productivity long term, but we may get a little pocket of sort of unemployment spiking, especially if the applications come down quite quickly. So that's something we're thinking about.
Well, the risk that I see is less immediate, but I think it's quite profound, and that is changing in demographics. Right across the world, you're seeing the birth rates are lower, so fewer people are entering the workforce. Now, Australia's got among the best demographics in the world, but it's also quite different than it was 10 years ago. Other countries like Southern Europe, as well as the United States and particularly China, are seeing their working age population decline. It's hard for an economy to grow if the number of people isn't growing to support it, which of course creates demands for productivity. We had a big political productivity powwow recently. Now that creates challenges for an economy. We all want to grow and get wealthier, but it also creates opportunities. Of course, AI is part of the conversation, but it will put enormous pressure on government budgets, but within that, there'll be enormous opportunities. So I think demographics, a decade ago, it might have been on the distant horizon. It's happening right now, and little by little every year, it's having a more profound impact. And within that, there's some interesting challenges and also some really interesting opportunities.
Yeah, so for me, it's mainly inequality, to be honest. It's because of technology. So a lot of the things we talked about today that are positive, as things digitalise, they all end up in the one place. Does that make sense? So Netflix comes along and Netflix basically slowly crushes Channel 7, Channel 9, in the same way Google came along and slowly crushed the newspapers. And so as things become digital, you end up with just these few winners and this few company effect we started with. The same sort of happening in society, if that makes sense. So because of that, rich people are getting significantly richer than they probably did in previous generations. And at the bottom, more and more people are getting left behind. And in theory, that could get worse in an AI world. And so that inequality, if you go back through history, it generally ends pretty badly at some point. And I suspect, that day, or you might get these rogue political outcomes, like a shift to the socialists, which is happening in New York, for instance, at the moment. And so that's the thing we'd worry about the most is how do we solve for that over the medium term if we know if we know there's this underlying force that's not going to work against it, if that makes sense. And so something's going to have to come along to work against it. And hopefully we do that in a thoughtful way, not in an unthoughtful way.
Beautiful segue before, Nick, the punch in the face. Now you can't double down on HelloFresh. You're going to find another one.
thought that question
No. You need to find another one. So start thinking. I'm happy to start at Sean and work back. Okay, so I'll do that. So, the punch in the face, Sean. We all stock pickers make mistakes from time to time. You guys make less, but you do make the odd mistake from time to time. Perhaps a mistake that you've made in the last few years and what you've learnt from it and how it's impacted the investment process as well.
Yeah, of course, and unfortunately there are a few. But one that sort of sticks out in my mind, I've learned a lot from, was there's a company listed in Australia up until a couple of years ago called Costa Group, which was basically a fresh fruit and produce grower. The core of the business originally was blueberry IP, where you probably would have seen it. They do a lot of the blueberries in the Driscoll's brand, and they had the IP for the big blueberries. But we went into that investment. The company had a pretty rocky sort of 6 to 12 months after the drought in 2019-20, and we felt like we were getting access to a decent business at an attractive price. What then happened over the next couple of years was there was a couple of external headwinds they faced due to some pricing issues, but there was also the company went and spent some money on an acquisition that put the balance sheet under pressure, and then there were some further sort of cyclical headwinds, and it all sort of unravelled, and the company ended up getting taken over, but it wasn't a good investment experience for us. And on reflection, I think the key sort of crux of the mistake and the lesson I've learned is that at all times during that process, it was very easy on a spreadsheet to say this company looks cheap and its value is 20 or 30 or 50% higher than where we are today. But that kept falling over time. And when you then got to the end of the process and looked back, you said, well, I probably should have realised 18 months into it that price had fallen, and why were we still justifying the investment case? So what I've sort of learned off the back of that is it's really, really important going into investment to be crystal clear on what your thesis is. And as soon as something deviates from that, whether it's a management decision or an external factor, that you need to have a really good look at the original investment case and almost come up with a new one as to why you want to buy it at the current price.
Sean's got young children, so I think he was spending $30 on blueberries a week at the supermarket. He thought it was a good investment. He wanted the natural hedge, but that's okay. Stephen, yourself.
Well, Patrick, a recent sale from our portfolio that on reflection was a mistake was a US-based business called Copart. Now, Copart is one of two companies that provide an auction solution to US auto insurers who are selling cars that have been deemed too expensive to repair. So in that case, the car owner gets a cheque, there's your cheque, That's your insured value, and then the insurer takes the car. What do they do with it? They have to sell it. The fun fact is, about 25 years ago, 2 in 100 cars that were in an accident were deemed too expensive to repair. Today, it's about 20. It's been an interesting rising market. All the electronics and things that make driving great make the cars more expensive to repair. It's a business with only one competitor, and herein lies the mistake. Over the last decade, Copart had been a share winner, and when you think about network effects and the buyers of these cars want to go where the more cars are available, the insurance companies want to utilise the selling platform where there are more buyers, so buyers attract sellers and vice versa. So it had been a consistent share gainer. The mistake we thought was it's a bit like an arm wrestle, that the further you get away from equilibrium, the harder it is for the share loser then to sort of fight back and restore balance. But sometimes it's not quite as hard as you think. It's a bit like, to use that boxing analogy, you think the victor's sort of hit the final punch and the countdown's on, he turns away, and then someone else gets off the canvas and the fight's back on. In Copart's case, their primary competitor had been sold about 3 years ago to a company that was willing to put more money in to improve the proposition, and they are now regaining share. So that changes the whole proposition for us rather than being a forever share gainer. It looks more like perhaps Coles and Woolies in Australia. One's a share gainer for a handful of years and then the pendulum goes back the other way. And so the lesson for us is to be very wary of businesses that have only one competitor because they'll look indestructible. They'll look better than they are when they're gaining share, but that share gain may not continue forever.
Not HelloFresh.
Not HelloFresh, damn.
You've only made 2 mistakes in the last few years, so we need your second one, Nick.
There's so many. So the important thing to remember, go back to what I said at the start, and don't beat yourself up about this. Most stocks destroy value, okay? So if the equity market's a game of few winners and lots of losers, then most of the time you've probably invested in a loser. And so what we spend a lot of time on is the process of identifying it's a loser. And I will give you a loser, I promise. But
He's trying to trick you here, guys.
I talked about the stop-loss process. That's the best one. That works very well for you. You're not forced to sell it. You're just forced to review it. The other one we do sometimes is, or we now do as a part of our process exclusively, is we write a pre-mortem. So we write down, before we invest, the 3 ways this can go wrong. And that comes back to what Sean was talking about. If you write down the 3 ways it's going to go wrong before you invest, when it starts going wrong, you won't convince yourself that it's okay. You won't convince yourself because you'll go back to what you already wrote. Okay, so the one I'm going to give you is why I left China in the first place. So we used to own a lot of Alibaba. I thought Alibaba was going to be the Amazon of China. I was very excited about Alibaba and Tencent, to be honest. And we owned these companies. We did very well out of them, 2018, 2019, 2020, 2021. These were always the ones that catch you, the ones that you've been doing well out of for a long period of time. And then if you remember, the Ant-IPO got pulled. Does anyone remember that? This was around the time the government started to crack down on these big companies. And we didn't realise at the time what was going on, but they fell 20% from peak. So we had to go do some work. We can decide to keep it, but we can only keep it for 30 days. In 30 days, we have to have the conversation again. 30 days, we have to have the conversation again. And so in that 30 days, we're off doing work. We're calling the analysts, we're calling the companies. And I remember distinctly calling Alibaba. And we spoke to management. We said, share price is down. How's business? What's going on? And they said, you should be aware in the next quarter, there's going to be a $4 billion abnormal. And I said, what's that? And they said, we're donating some money to the Health and Prosperity Fund of China. And I said, what's that? And they said, well, it's something the government's asked us to do, and we're going to donate some money to this area. And we're like, well, we have no idea what the earnings of this company are going to be. So even though we've lost 20% off the peak, let's step to the sidelines. And the company's since fallen 80%. It's been 4 horrible years in China as this crackdown's occurred. And if anything, we're now happy to go back, because one of the benefits of Donald Trump is that he's all about national champions in the US, which means China's now all about their national champions, which is why Europe's about all their national champions. The valuations are much lower and we're happy to go back. But that's a good example. And so the point is if you have that reaction function, you'll get on the phone and you'll find out what you're missing. And when you find out what you're missing, then you've got the facts to make the next decision, which is hopefully the right one.
Okay, so lucky last question before James comes up and facilitates about 10 to 15 minutes of question and answer. Now, we give our panellists plenty of time to have a think, and what we're asking them to do is to come up with one investment idea. If they could only invest in one thing right now, what would that be looking forward? Now, Before we get each to answer, I just want to preface this by saying you'd never only own one investment, number one. Number two, we've been very fortunate that in previous years our panellists, and Nick in particular, have done incredibly well with that one investment that they've selected. So please, if Nick's going to say NVIDIA again, please don't ring us this afternoon and ask us to buy NVIDIA, because we're going to come back to you and say you should put a little bit more into one of these astute gentlemen's funds, okay? So, but for a little bit of fun and to keep everybody's attention a good hour in, the question for these astute gentlemen is, if there was just one investment that you could purchase right now, looking forward for our clients, what would that be?
All right. Look, so I think I'll get to the stock, but I guess the theme that this stock fits into is healthy eating and awareness of health. And I think what we've seen, it's been a trend, but increasingly so over the last few years, is people's awareness of their health and what they're eating has increased dramatically. Part of it's been improvements in information, but also technology with the Apple Watch and the wearables. People are more aware of what's going on in their body. And then, again, more recently, the whole weight loss drug sort of proliferation, I think, has put a lot more focus onto healthy eating. And one stock that we own, and I think the outlook over a long period over the medium and long term remains very attractive, is a company called Cobram Estate Olives, which is an Australian company, and you may not have known it's listed, but I'm sure many of you use their products in your kitchen at home. Cobram is, all they do is produce and sell extra virgin olive oil. Now, extra virgin olive oil within the edible oils category is the healthy option. Consumers are increasingly aware of extra virgin olive oil, its health benefits relative to seed oils and those sorts of things. So the underlying trend towards extra virgin olive oil and the demand is very strong. Now, Cobram within that in Australia, they produce about 70% of the olives on farm. They've got excellent assets. They built up over a long period of time, but they also have 40% of the value share in the supermarkets through their branded product. And that vertical integration for a primary produce company is very, very powerful relative to their international peers. Now, where we think their story is interesting and why I think in 10 years' time it'll be a much bigger business is, for the last 7 or 8 years, they've been replicating in the US what they've got in Australia. They've been buying lots of farm assets, been building it up, and the brand's now hit the inflection point where it's, I think, 7th or 8th biggest selling olive oil brand in America, and their farming assets they continue to invest in quite a lot, and it's got a very good management team. So I think overall the trend's very positive in their favour, and they've got a very unique set of assets globally within that sector. So I think in 10 years' time it'll be a much bigger business.
Well, the company I'll give you is L'Oreal. Now, in any one year, it's never going to be the most exciting business, but you think about it in terms of long-term compounding. Business has been around for 116 years. It's only ever done one thing. It's a very broad, balanced business. It serves every part of the beauty sector in every country in the world, multiple price categories across lots and lots of different brands, and that's made it not only a remarkably resilient business, but also been a remarkably successful one. It's outgrown its market in 19 of the last 21 years, and I think it can compound its earnings at about 10% per annum. The average business internationally does 5, so if you think about the difference between 5 and 10 over a decade, I think it'll get to a very, very good place. Now, why right now is interesting is China, which a handful of years ago was about 1/3 of their revenue, is today's only 17%. Meanwhile, the market's still very focused on China. Chinese market is not growing at the rate that it was a few years ago. It's stabilising. Last year it was poor. The market's focus is far too much on China. It's missing the bigger picture, which the business is broadly growing very successfully, taking market share in almost every part of its business in almost every country in the world. The other emerging markets like India, Eastern Europe, Middle East and Latin America collectively account for more than China, and they're all growing very, very well. So here I think you have a remarkably durable, successful business where the market's far too focused on one part of the business and missing the bigger picture, which I think will produce a very, very good outcome over the next decade.
Can I do NVIDIA again?
Absolutely.
No, I won't. Look, I'll just make the point that, so obviously we talked about NVIDIA for the last couple of years here, and I still really like it, by the way, and it's still the largest position in our fund, but we have obviously top sliced it along the way. And when I say largest position, like a 6% position, so it's not the whole fund, just to be clear on that. Look, I think people have got to start getting their head around how important compute is and how the future is going to work. and how important the semiconductors are going to be. And so we're very lucky in the fact that we've sort of understood semiconductors for a long time, and semiconductors have become more and more important in the world. And I will get to the company in a second, I promise. And so the way you should be thinking about this is we're now having active conversations about how we're going to interact with computers in the future. You might not interact on a screen, you might just talk to it. You might talk to your car, you might talk to your computer to get the results. And so this has profound implications for things like software companies like Salesforce or potentially Microsoft. It has profound implications for information services. But it has the very positive implications for those shovels I talked about, all that data center spending. And so the one catch-all way to buy every single, basically all these high-end semiconductors that are going to grow these data centers for the next decade is to buy some shares in TSMC, which is called Taiwan Semiconductor Manufacturing Company. There is one problem with it, which I'll get to in a second. Okay, but TSMC makes all of the world's semiconductors. So NVIDIA actually doesn't make them, it just designs them. AMD doesn't make them, it just designs them. Broadcom doesn't make them, it just designs them. When Amazon and these other guys are making them, they're just designing them. They're all made by TSMC, and they're all made on the island of Taiwan. So TSMC is a $1.2 trillion company that effectively dominates this market. We think semiconductors are the new oil. The beauty of TSMC, it trades at just 22 times earnings because everyone's worried about the Taiwan bit. But it's growing at roughly 25% per annum, I think, for the next decade. And so you're going to get amazing compounded returns. On top of that, they're going to continue to build manufacturing capacity in the United States to diversify away from Taiwan and diversify into Japan and Germany as well. There is obviously the Taiwan bit. I would just point to the fact that if Taiwan did get invaded by China, you're going to have a lot bigger problems than your shareholding in TSMC. Because you can't make a computer, you can't make a plane, you can't make a car, etc. So I know that there's a small risk that this happens. I think it's less and less every day as people realise how important this company is and how important semiconductors are going to be into how we live for the next 50 years when GFM celebrates their 100-year anniversary. So that's my one tip.
Righto, over to you, James.
How about a round of applause for the gentleman up here? Thank you. So we have a bit of time, probably about 10 minutes to go through some Q&A. There's a roving mic. May, there's one down there. And there's just the one. And one down there, Widdy, as well too, okay? So we'll start just over where May's, please. Thank you, May.
Stockbrokers are a bit like real estate agents. It's always a good time to buy, whereas we investors know that's not true. And Warren Buffett is currently sitting at 30% cash, I believe. So I'm more interested in what's going to go wrong rather than positive scenarios. So it would have been better if you guys had had your best sell idea. Is CSL a sell or a buy? Anyway, thank you.
Not sure if there was a question in that, but maybe we did talk about potentially areas that the gentlemen were concerned with investing, and particularly Sean and Nick also spoke about their ability to short sell. And I thought Stephen, and I'd be really interested to read that piece, Stephen, on the sell discipline. But maybe we can get a comment from you guys about, everybody's looking at Buffett and the 30% cash and the like.
Double talk, all that sort of stuff.
Yeah, that's right. So, Nick, you said not to say it, but, there is talk that we're in a bubble at the moment. Yep. So how are you guys viewing that? And we'll get an answer from each of you.
Yeah, okay. So generally you're not in a bubble when everyone says you're in a bubble. You're in a bubble when everyone believes it can go on forever. That'd be my first comment. Second comment, the market's only up 14% this year, so that's not a bubble. I was around for the last bubble. The NASDAQ went up, so was Steve. We're in London. The NASDAQ went up 99% in the last year, in 1 year. It went up 60% in the last 4 months. That's a bubble. So it doesn't feel like a bubble today. But don't be, markets will get ahead of themselves and correct. We've seen that already this year. We've had one big correction. I suspect we'll get another correction in the next 12 months. But I'd just remind people that, actually being long-term invested is actually the right outcome. You are getting quite good returns, and that's what your advisor's here to help you do. And the volatility day to day is definitely worth, it makes good headlines, but ultimately over the journey, the returns you're achieving are actually incredibly good. And there's nothing at least that we can see today, that what don't suggest it won't continue. I would have said that on February 2020 as well, by the way. Sometimes things come from left field. Our product has the ability to move to the sidelines. It has the ability to short sell. It has the ability to raise cash. That's always helpful. But right now, that's how it looks for us today. And we are still medium-term positive markets, even though they probably will get ahead of themselves and correct. Nowhere near the bubble today from our point of view.
I think for me the key is to keep your eye firmly on the long term. Markets will go up and down even from cheap valuations. Market being in a bubble isn't a precondition for markets to fall. So A, if you have your eye firmly on the long term, and two, accept that markets will go up and down, I think it's a very good starting point. And number two is to separate what happens in the index with what happens in individual stocks. If the market falls, it doesn't mean every stock falls the same way unless you own the market. So you can either choose to be a passive index owner or, as per the discussion, have a very selective approach, in which case you own good, growing, long-term compounding businesses at good prices, and your performance will probably look very different from that of the market.
Yeah, then the odd, I mean, if we rewinded sort of 6 months and we'd said, okay, in the next 6 months you're going to have a tariff war, you're going to have all the geopolitical uncertainty that we've seen, I wouldn't have forecasted the market to have done what it's done now. So I guess it's easy for us to sit here and say, like, there's a number of things that could cause a market wobble in the next 6 to 12 months. There's a lot of focus on the private credit market in the US at the moment and what may eventuate there. So there's always lots of risks and uncertainty to focus on. I think for us, we always bring it back to valuation. So if companies are getting them ahead of themselves in terms of what we consider to be fair value, we'll use that as a trigger to sell and rotate that capital to other pockets of the market. And I think our observation on the overall market would be that you can look at overall index multiples and say, oh, it's pretty expensive for the Australian and the US market relative to history. But because of that momentum factor I talked about before in markets, there are still pockets of the market that look extremely cheap relative to history. So I think to react purely just to, I guess, the headline risks and the market multiple might be leaving some opportunities on the table.
I think there's a couple of unique Berkshire Hathaway things as well that you guys might be able to correct me about here as well. But it's a very, very big company now. It's one of the 10 biggest companies in the world. Part of the decision for that cash was to reweight a very, very large position in Apple that they had. So they sold out of Apple. And the problem that Buffett ultimately now has, he's got that much cash. In order for him to move the dial, he needs to make a really, really sizable acquisition. So it's just a really, really delicate balancing act for him as an investor. So there were some genuine reasons for selling down that cash, that really large Apple position. And yeah, for him to move the dial in terms of portfolio performance, he's got to buy something really chunky.
I'll just throw one thing in before we get to the next question, and that's that negative headlines sell press, positive headlines don't. So you're going to see negative headlines. I think if you're negative for long enough, eventually you'll be right, okay? But the question is, what did you miss out on? Okay, so I think it's time in the game, and sometimes you've got to block out the noise. Not suggesting that it's not an environment, it possibly is an environment of enhanced risk, but I think as Sean said, what have you missed out on in the last 6 months if you got negative about tariffs and about the geopolitical environment?
Woody, I think there's just here on the table, please. Just here, Woody. Just there next to you. That's it there, thank you. And then we'll go up to the front, thank you.
Yes. Nick, you were talking about investment in AI and investment in security. There's been an awful lot of talk about deep fakes and all the rest of it. So if I've got a body-worn camera and I want to do something naughty and I've got a readily available concentrated ownership of AI generation, that evidence suddenly becomes questionable and confidence across the whole AI industry goes. What happens to those investments once that almost inevitably happens?
Yeah, I suppose, look, every technology's been used for good and bad since, so people would sit here today and say social media is bad, right? They'd say Facebook's bad, social media is bad. They would. Yet lots of people use it, if that makes sense. So there's going to be good and bad sides to every technological change. There'll be good and bad sides to this one. I agree with you, the deep fake stuff's getting pretty good, and it's going to get a lot better, so we're going to have to find a way of digitally marking those to make sure that that's there. But I wouldn't stop us from trying to do the progress, if that makes sense. And I'd also point out that you're not going to be able to stop the progress happening, because it's going to, if you don't do it, and this is what Donald Trump's being very articulate about, to be honest, is he wants the US to win the AI race, because if they don't win them, then China will, and the technology's supposedly better in their hands than it is in China. I don't discount the problems you're talking about. I'm sure they're going to come up. I just don't think it's going to slow anyone down. It's not going to stop anything happening. And so from our point of view, we always try to take the good side of this equation, but I accept that bad things are going to happen with this technology.
Okay, just down here. Thank you.
Yep, take it.
Do you see a potential danger in the massive state debt America is taking on of several trillions for the world market?
So as in the US is the most of the market globally?
No, the debt, state debt.
Oh, the debt.
The trillions and trillions.
Thank you. Yes, yes. The big elephant in the room. Yes, this is a big problem. Okay, so the other thing in the questions, what could go horribly wrong? And I said inequality. The other thing that's out there that you could easily say is that eventually this debt burden gets so big that no one buys US bonds and everyone queues up and buys gold instead. And that's happening right now. And so if there isn't a buyer, same here in Victoria, okay? So like, let's assume that Victoria might be in a little bit of financial trouble. I think that's a reasonably safe assumption. The only thing that's going to stop Victoria spending money is when the bondholders say, hey, we're not going to lend you the money anymore, okay? And our interest rate's going to go up and up and up, and then we're going to go technically broke in the same way Sean talked about some of those countries. That could happen to the US, for instance. It's probably more likely to happen in France or one of these European countries first, and that would be a bad thing that would happen, because that would raise the discount rate that we all invest in, so all the way back to the very first question, and that would lower the value of the stock. So that is the one thing that's bad out there. The only thing I'd say about the big debt problem is it's been there the whole time. Like you could have asked me that same question last year or the year before or the year before or the year before, and every time there's been a buyer for that asset, and every time these companies have innovated, their earnings have grown and their share prices have gone up. So we're not discounting that as an issue. It is an issue. I just can't tell you when it goes wrong, but it's definitely something we watch quite closely. Hopefully that helps answer the question.
Okay, May, just the front here, please. Thank you.
Question about the AI race. AI consumes an enormous amount of computation. Enormous amounts of computation require huge amounts of energy, power. The quick way to get more energy into the grid is through renewables. The US has been hell-bent on cancelling renewables, be it wind or solar, or and relying on fossil fuel generation. I read an article recently that seriously suggests that the US will lose the AI race through the most banal, for the most banal reason of running out of energy, running out of power. Is this the way the AI race ends?
It's not how it ends, but it definitely means it might go for longer. So I agree, power is the big issue, and so we didn't talk about it today, but one of the other areas we've invested in is to invest in climate. We actually have a climate fund that invests in the enablers of decarbonisation, and we actually launched it 4 years ago, and like a lot of things at the moment, it's intersected with AI in the same way security is intersected with AI. This is going to keep happening. Look, from our point of view, yes, they need to build a lot of power to win the AI race, and that's an opportunity for the companies that build power stations. We think the technologies they're going to go for, I agree, they're shunning renewables. I don't think it makes any sense, personally, because it is the cheapest and fastest form of new energy. But they're going to go for gas, and they're going to go for nuclear energy. And so we've adjusted our investments accordingly. We own Constellation Energy, which is the largest installed fleet of nuclear power plants in the United States. And the reason why you buy existing nuclear is because they can sell it for a premium. And secondly, where's the best place to build a nuclear power plant? Does anybody know? It's really easy. Where there's an existing one, where there's already a nuclear power plant. And then things like GE Vernova, which makes gas turbines, or Siemens Energy. It's a 6-year wait to buy a gas turbine now. They're actually digging them up. They're buying whole power stations in Thailand, taking them apart to get their gas turbines to get it to the US. So this is a boom. It's a boom that these companies will benefit from. And you're right, the big governor to the boom is power. And so expect a lot of investment in power and a lot of companies to win from it. And our job is to identify the structural change and identify the winners. I just told you to. And will they win the race? Don't know. Depends if they can permit enough power. But they're good at permitting stuff, the United States, particularly when it's Republicans in control. So we'll see what happens.
Okay, we've got time for a couple more. So I think there was one here and there was another one. Someone's put their hand up somewhere around here. Just over there. Thank you, Woody. And then just over here.
Hi. I was just wondering if there are opportunities in investment in immigration and the education sector. Those two you didn't touch on.
I think it's a good question for Sean.
Yeah, look, I mean, there absolutely should be, and I think Australia, I guess, given what we offer from an immigration education perspective, is very well placed to offer that. I mean, sort of the bellwether of it in Australia, particularly on the education piece, is a company called IDP Education, which offers English language testing and also student placements into Australian universities. And the stock had an amazing run from 2015. It was originally owned by Seek and got spun out up until a couple of years ago. And what changed, and I guess has caused the share price fall from sort of high $30s down to as low as $4, was the caps on immigration and students globally, and especially in their key markets of Australia, the UK and Canada. So I think absolutely there is potential for it to be investment. I think now, given where we are in terms of overall student enrolments coming into Australia, that it's quite an interesting point for the company where these things tend to go in cycles with the political cycle in terms of how many people we're letting in, how many students are coming in each year. So that for us is one that we're looking at the moment. We don't have an investment there per se, but there should be investment opportunities in Australia, given, I guess, how strong our education export is.
Okay, just here.
Just the subject of cryptocurrency. I'm talking about bubbles and whether the crypto, how that's being financed by people who are spending millions and millions of dollars of buying something that's essentially worthless.
Paul, can you do the caveat at the start first, please?
I said there was a moral we were going to get a crypto question. Which of you gentlemen want
I think Steve should answer this one.
My answer's a short one. I've got no idea.
Go on, Nick.
Okay, so there are lots of little bubbles going on in the market right now. Quantum computing, I would argue, is a bubble. Crypto could be a bubble. Gold could be a bubble, where people are queuing up to buy things that they think are going to be worth more in the future. We would just argue that we buy companies with earnings and earnings growth drives the share prices. So I agree with you on the why there's not the foundation of what you're buying is potentially not there. But I also think that, that there is a use for these things in the future. And if they're right, then they could be worth a lot of money. So if people wanted to put a small portion of their wealth into a cryptocurrency, I wouldn't have a problem with it. But you should never put more than 10% of your money in anything. Even our fund, even one stock. You should stay diversified if you want to do it. But that's what they're going for in crypto, and you're going to keep seeing this happen. These little bubbles inflate and hopefully pop to help this bull market last. Hopefully the 5 years that I said that we think it will, and potentially longer.
Leverage in cryptocurrency was fascinating. We got this correction a couple of weeks ago. Little bit of a hard concept to understand, but where you can borrow $1 and buy $10 worth of cryptocurrency, it wiped out 10% of people's accounts. 10%. 10% of people had money in their account and had no money or owed money at the end of the day because of the leverage. Crazy stuff.
And you want to see that keep happening. We need these. No, I'm serious. People can't be allowed to make money for free, and if they think they can, we will end up with a bubble. We will, and I'm not saying we won't in the end. We're definitely not in one today. But you need these little bubbles to pop to keep the discipline in the markets that we need to continue to get rational returns in the future.
Okay, it's right on 2 o'clock, so I think we'll call it a day. Just a final applause for Nick, Steve and Sean, as well as Paul and Patrick for asking the questions. Thanks, gentlemen. Okay. Thanks again for everybody for attending. I hope you found it a really informative and fascinating session. We really enjoy presenting this kind of Q&A every year. We've got a couple more functions left before the end of the year, so we'd love to see you more before we get to that time of year. All the best. Have a lovely day today.